Okay, this is Hosen Part 4. Let's get it over with. I know a lot about economics, about macroeconomics. I know a lot about psychology. And what I'm hearing on financial TV, and I watch a lot of financial TV because it's my best source. I have to fast forward through 99% of it. But that there's, going through, I spend maybe 4 or 5 hours a day. I record 8 hours and maybe spend 3 or 4 hours watching parts of it. And maybe 15-20 minutes of it. Actually, there's something said that I learned from. One of the things, this was on Strategy Session with Kaminsky and Faber on CNBC, they had a guy from Blackstone who said they had accumulated a lot of money to buy distressed debt, to go into the loan business, that they were getting really good margins. And these are businesses that banks may not be able to conduct in the future. And to the extent that business lending goes on, it could be profitable. Then Leon Cooperman recommended KFN, which is KKF Financial. And this is a company that buys assets, buys real estate assets, and earns income from that. Could be mortgages, could be actual properties. And Cooperman said it was worth a great deal more than the $8.50 it was selling for at that time. It pays about 8.9% dividend. I own it. In fact, I own quite a lot of this, based on Cooperman's argument. But the idea is that companies like this can take businesses that used to be part of banks, in which banks really didn't do it that well, and they don't have much competition now. Annaly Mortgage is a mortgage REIT. They buy mortgages using borrowed money, and they make the difference between what the mortgage pays and what they pay for the money. And since we know that short-term interest rates, we've been promised by the central bank, by the Fed, that we're going to have low, really low, excessively low in my opinion, short-term rates, so that people like Annaly can get rich. Of course, they use another justification. So I bought Annaly. Annaly pays about 14-15%. NLY is the symbol. I used to own several other mortgage REITs that paid more. But Annaly seems to have a strategy for the future. If there's ever mortgage lending again, it may be through companies like this. Now, anytime their stock goes up, they issue more stock. They dilute their shareholders. So the stock over any period of time is not going to go up. But if you're satisfied with a 14 or 15% dividend annually, and if you're willing to risk the fact that it could go down, then this is a pretty good investment. See, it used to be, I had 8 straight years, beginning in '03, of 20% plus returns. Even in 2008. Well, yeah, now I'm not capable of that. I may not even be capable of 0. I may be completely senile tomorrow. But today, 14.5% is enough. Starwood Property, STWD. It's a real estate investment trust. They own real properties and mortgages. And they've raised money to buy distressed debt. It pays, right at the moment, about 9% dividend. And I believe that this form of organization, this kind of REIT, which is partly property, I don't think they'll, I think it's possible that there could be appreciation. They're going to start buying the stuff that the banks in Europe are going to have to dump. And they're going to have to dump them at distressed prices. And Starwood is sophisticated. I'm pretty sure that the head of the company is an American Jew. And if you want somebody who's going to buy distressed real estate and do it sensibly and make a return, it's a good chance it'll be an American Jew. Fifth Street Financial, FSC, pays 11%. Now, they're called builders, business builder corps, and they're like REITs. They have to pay out all their earnings, and what they are is a loan company. They make loans to businesses, and they borrow. Either they borrow in short-term markets, or they borrow from banks at 3% and lend it out at 10 or 12. So Wells Fargo doesn't actually want to make loans. That's beneath them. And it's too costly. So they lend a big chunk of money to Fifth Street Financial or BlackRock Kelso, which is another one. And these companies then mark it up a lot and they make loans. But they know their customers. So if they have any judgment, they're okay. These companies dilute their shareholders. So if Fifth Street Financial, which pays 11%, or 11.5%, or BlackRock Kelso, BKCC, another company like that, pays maybe 12%. They at least are trying to know their customers. They make loans. They may buy some equity in the company. These are people that are, that are operators on the ground. And since you can't be an operator on the ground, and if you think 11% is enough, then, I recommend FSC or maybe BKCC, BlackRock Kelso. So these are business loan companies, and they know their customers. Small companies that don't want to go public, too small, don't want the hassle. Blackstone BX, that's a private equity firm. They've raised money to buy distressed assets. They're getting into the finance business. I saw a representative on CNBC, and you know, it looked to me like Blackstone may make some money on this in the future. It pays a little under 3% at the moment. And there are a few other, like KCAP, that's like Fifth Street Financial and BlackRock Kelso, Kohlberg Capital, KCAP, and it pays about 10 or 11%. I looked it up because Kohlberg left Kohlberg, Kravitz, and Roberts, I think, to found this about 25 years ago. I saw Kravitz interviewed, and he talked about private equity business and what they were doing. Anyway, I thought he was an asshole, and I don't even know whether he runs the business now. He looks kind of old. But anyway, I got the impression he was a jerk. So what have I given you? I've given you some Chinese companies which I think you ought to look into, and not to buy at the moment, but to wait till some non-fundamental event. Now remember, the markets, if you want to understand the market, pretend that the participants are on acid, speed, Valium, or some combination, or some alternation. And then what it does, you know, is a product of these mind-altering substances, plus the craziness of the people who do it, who take them. And so when craziness puts Chinese stocks down, I mean Chinese craziness, yeah, then use Western non-craziness to get some bargain. And if you think that the banks are in the dumper forever, and that we're never going to have a really viable financial system except on a very small scale, then these little companies, Annaly, KKF Financial might be different. Kupperman has a big position in that. He's a very successful hedge fund operator. And this is a company that is capable of buying distressed assets. So these are, oh, let me just mention two more. Karen Fineman on Fast Money. She's a value investor. She doesn't belong in Fast Money. And her record since she's been on there indicates that. But she's fairly sharp. She knows details. And they like her a lot on the program. And she's a regular guy. So she's on there. Her husband has a building development firm and maybe some other kind of investment company. She says Polycom, PLCM, is a company that she thinks has a future. It's video conferencing. And she sees a time when video conferencing will be done just routinely. Everybody will have video conferencing next to them, you know, next to their desktop or whatever they're using at work. I mean, it won't replace travel, but it will supplement it in a much larger way. And Polycom is a way to play that, and it's a company that she says generates cash and has earnings. At the moment it's about $18. It has $1.05 earnings, maybe next year $1.20. Okay, one more.